and its impact on gold. This is Phil, your presenter for today. We'll be starting the session shortly at 7:02 p.m. Just give a couple of minutes for some more of our friends to join us. Meanwhile, just relax for a while and we'll start in a bit. Once again, thank you for joining us for our live webinar today on quantitative tightening, runaway inflation, and its impact on gold. This is Phil. I'm a Senior Sales Manager with Sorry about that. If you can hear me, before we begin, let's do a sound check. Just type yes into the question box if there's any sounds. Also, during the webinar, if you have any questions, do type them into the question box and I'll address them during the end of the session. Okay, great. It looks like everyone can hear me clearly now. So let's begin tonight's webinar. My name is Phil, the speaker for today's webinar. I've been with Phillip Nova for 12 years now, since 2008. I hold a dual license in futures and stocks, and I'm an account manager to help clients trading in futures and forex, as well as stocks and shares, with the understanding of the product and market by providing coaching and economic information to make proper trading decisions. Earlier this year in March 2022, we have seen gold prices testing new highs of $2,074 per dollars per ounce. This is a swift decline and a correction has occurred. This is definitely a result of Fed's policies and actions. As we know, inflation has been a headline globally. We can already start to see rising interest rates in Singapore and how it affects our mortgage rates as well as bank deposits. However, in today's webinar, we'll be discussing gold prices. Gold itself is a metal and does not give any returns. It is, however, a good storage of value in times of uncertainty. Hence, investing in gold is purely a speculation of the price of gold. We'll explore the fundamental factors that influence gold prices and try to determine whether gold prices have bottomed out. But before that, we'll first touch on understanding the mechanisms of the two ways of investing in gold, which are COMEX and spot gold, for the first half of the webinar. As mentioned, throughout the webinar, if you have questions, feel free to post them in the question box. My facilitator will consolidate them and I'll reach the We'll discuss it during the end of the webinar. This webinar itself will also be put up on YouTube after today. So if you want to revisit it, you can do so after today as well. All right, let's get right into it. Before we start, a disclaimer on webinars today. Materials provided here are for general information and do not constitute a recommendation or solicitation to trade. The topics that we'll be covering are as follows. The first part of the webinar will be understanding the product. We'll be looking at the contract specifications of gold futures. Therefore, we're looking at tick size, expiry dates, etc. Taking a look at the difference between the trading COMEX Gold Futures as compared to its counterpart, the spot gold. At the end of that, we'll look at some scenarios or trade examples to understand the profit and loss calculation in executing trades. After that, we'll be discussing the fundamental factors that affect the price of gold, touching on recent events and the outlook of gold in the fundamental big picture, while looking at inflation and interest rate hikes and also how the outlook of it is going to be. Besides fundamentals, I always advocate a broad approach of looking at technical analysis as well to have a good idea of the ideal price levels to enter and exit, as the price levels determine how profitable the trades are going to be. Technical analysis will also be put in perspective on the current scenario, whether the gold prices have actually bottomed out, what is the big range that the gold will be trading in, and other questions. Lastly, we'll have a look at the questions Q&A, if you have any questions at all. All right, let's get started. What is COMEX Gold Futures? First of all, gold is viewed as a safe haven asset. COMEX Gold Futures is a contract that is traded on the U.S. COMEX exchange. Like all exchange-traded products, it is fair and transparent. Market prices are determined by each individual participant in the market. The market participants can be institutions or retail investors. When you trade in COMEX Gold Futures, you do not own the underlying, which is the gold itself. It is a pure speculation of the gold prices. As it is traded worldwide electronically, there's superior liquidity, which will translate to tight market spread and the easy exit of contracts. The market is always filled with participants. There is a trading volume of 27 million ounces daily. As of today, the average trading volume for the micro gold contract is 40,000 contracts and 220,000 contracts for the regular contract size. The price of gold itself is shown in ounces. So 1,670 is the price of gold, means for each ounce you pay 1,670 US dollars. Let's take the analogy of buying physical gold. If you were to buy a gold bar, a 100-ounce gold bar, you will pay 1,670 per ounce. That will cost you a total of 167,000 US dollars. When the price rises to 1,700, you can sell the gold bar for 170,000 US dollars, making a net profit of 3,000 US dollars. COMEX Gold Futures works the same way except without the physical gold. You can speculate on the gold price itself electronically over the internet. This is more efficient and timely as the prices are updated every second. Next, we'll go on to how do you actually trade the COMEX Gold Futures. First, there are two contract sizes that's made available for COMEX Gold. They are the regular 100 ounces contract size and a smaller 10-ounce micro contract size. The micro contract lot size will require an initial margin of 627 US dollars to start trading. A regular contract size, which is 10 times bigger than the micro size, will require 6,270 US dollars. This means you do not come up with the full value of the contract, but a ratio of it, as this is a leverage product. In the earlier example of 100 ounces, you do not need to pay 167,000 US dollars, but 6,270 US dollars is enough to start trading. Hence, you can buy it at a lower rate and sell at a higher price using the trading platform. For starters, you can start trading in the micro gold contract size. For example, if you were to buy 10 ounces of gold at 1670 and sell it back at 1670.5, that would be a profit of $5. The spread is very tight at 10 cents, and the commission is currently on promotion at $1.70 USD per side per trade. The round trip will actually cost you only $3, so you can break even with a 40 cents or 4 tick spread. Typically, the rate is $3 per trade, but the promotion is being extended till the end of 2022 and may be extended even further after that. So back to the regular contract size, the commission is at $12, so the break even will be at 30 cents spread. There is no interest charge for positions, but the contract expires every 2 months. So you need to do a rollover every 2 months. Or you can trade a further month, but that would be a wider spread. A rollover simply means closing out the current month position and opening a new position in the new month. For example, if you are trading the December month, which is the active month currently, and it's expiring coming to the last third week of the month of December, you can choose to actually maintain your position. If you decide to close the position, simply close out the position in the December month. If you wish to maintain the position, you can close out the position in the December month and open a new position simultaneously in the next month, which is February. What are the characteristics of COMEX Gold Futures? First of all, it is a bidirectional market. This means you can trade both directions of the market. If you think the market is going up, you can go for a long position. If you think the gold price is coming down, you can also initiate a short position. In this scenario where this is a down market, you can actually sell at a higher price and buy back later at a lower price. There are two contract sizes as mentioned, the 10 ounce and the 100 ounce. The micro 10 ounce contract and the regular 100 ounce contract can be done in multiples of the contract. So for example, if you wish to do 2 micro sizes, that will be 20 ounces of gold. The initial margin required is $627 for 1 micro lot size, and 10 times that for the regular contract size of 100 ounces. You can fund the account in Sing dollars, no problem, and start trading with the equivalent amount in Sing. But interest will be charged on the USD 627 for overnight trades. You can avoid this interest charges by converting the Sing dollars into US dollars, or simply just funding it directly in US dollars. For intraday tradings, referring to trades that's closed out before 6 a.m. Singapore time, it doesn't matter if your margin is in Sing dollars or US dollars. There is a daily settlement price at 6 a.m. Singapore time. The trading hours are continuously from Mondays to Friday. When you hold your positions past 6 a.m. Singapore time, it is considered as an overnight position. Your position will be marked to market based on the settlement price that is released by the exchange. If the market is going against you, a margin call will be triggered, and you will be informed to top up to maintain the position. More details on the margin call will be given later on. Only the even contract months are traded, so think of February, April, June, and so forth. You can choose which months to trade in. For short-term positions or intraday positions, it is advisable to use the nearest month. Example, currently December is the nearest month, rather than June. This is because the closer month or the active month has better liquidity, so the spread is tighter, and you'll be able to break even more easily. There will be no interest charges if the margin is made in US dollars, or if you are doing only intraday trades, which means you close out the trades before 6 a.m. every day. So that is one of the choice to invest in gold by using the COMEX Gold Futures. Next, we'll move on to the spot gold. On the Phillip platform, you are able to trade COMEX Gold Futures. However, Phillip also offers spot gold as an alternative to COMEX Gold Futures. It is basically similar to the COMEX Gold Futures, but with a couple of distinct differences. First, the similarities are firstly, it is also bidirectional market, which allows you to trade on both sides of the market. For spot gold, there's more control on the contract size, which you can go as low as 1 ounce of gold. So for beginners, this might seem a very good way to get started. The leverage is, however, much lower, which is only at 5 times. This requires you to put a margin of 20% of the contract value. So take, for example, a 10-ounce size contract will now require 3,350 US dollars. The spot gold is now traded on the MT5 platform instead of the Nova platform. So the MT5 is an auto cut system where if the funds become low and reaches 20% of the margin, the positions are automatically liquidated. Emails will be sent via the system to inform of any margin calls. There is no expiry date and there's also no rollover required. However, you need to pay swaps if you wish to hold the positions. Currently, if you are short position, you are actually receiving swaps. One thing to take note is that there's also zero commission on the MT5. So that's for spot gold. Let's take a look at the advantages and disadvantages maybe in trading COMEX Gold or spot gold. So first of all, you will have a very good control on the risk exposure. You can select in denominations of 10 ounces contract to decide the size exposure you want for yourself. Do take note that the regular and micro size are different contracts and they are not mutually offsettable with one another. If you trade spot gold instead, you can trade as low as 1 ounce of gold. Next, this is actually a very highly liquid market, and it allows live display of market prices of gold and live trading, as compared to other options out there, which is the physical gold bar or gold ETFs, which is based on the net asset value. There is no interest charges, but you need to roll over the positions if you wish to maintain your position when the contract month is expiring or is approaching expiry date. It is also offering a very tight bid offer spread of 1 tick, which is 10 cents, and it makes it very easy for you to break even after adding in the commission cost. As mentioned, the promotion rate right now is 3 USD for the micro lot size, so the break even is 4 ticks or 40 cents. Most of all, it is based on round-the-clock trading from Mondays to Saturday, starting with Monday 7 a.m. and ends on Saturday 6 a.m. Singapore time. You can also trade in the night trading during the US trading hours when the market movement is more volatile. We also have an app for trading, so you are able to trade on the move or at night on your PC after work. There's no trading during the weekends as the markets are closed during the weekend. So those are the reasons why COMEX Gold and Spot Gold Futures, COMEX Gold Futures or Spot Gold is advantageous. Let's look at the differences between COMEX Gold and Spot Gold in the table. So as seen over here, you have more control on the contract size if you are trading on spot gold, which allows you to trade in denomination of 1 ounce of gold. For COMEX Gold, it's either got to be 10 ounces per contract, or the regular contract size is the 100 ounces contract. So it will be denominations of 10 ounces each. Both contracts are highly liquid, so no worries there on the spread or entering or exiting the market. The COMEX Gold does not include swaps, so you do not have to worry about interest charges or swaps for the long term. The spot gold, however, has swaps, Well, it depends on the market direction that you're in. Currently, if you are a long position, you'll be paying swaps. However, if you are short the spot gold price, you're actually receiving swaps. This may change in the future as the interest rate of the dollar changes. Next, you have to do a rollover every 2 months for COMEX Gold, or alternatively, you can trade in the further month. For spot gold, there is no rollover and you can hold the position as long as you want. However, you will have to pay the swaps that's involved. The commission is very low. For each micro lot COMEX Gold contract, it's only $1.70. The regular size is 12 US dollars. So the break even is about 30 cents to 40 cents spread. For the spot gold, it's zero commission. So you do not have to worry of any charges at all except for swaps. The trading hours are similar from Mondays to Fridays, 7 a.m. Singapore time to 6 a.m. Singapore time on Saturday. So you can trade anytime during the weekday, whether it be at night or in the afternoon. But most of the time, gold prices are more volatile during the European and the US hours, which means after 3 p.m. Singapore time. So taking a look at the margin requirement for the COMEX Gold requires about 3.75% of the contract value. But for spot gold, you have to put up the margin as 20% of the actual value. So that sums up the differences between trading COMEX Gold and spot gold. I personally would actually recommend the COMEX Gold Futures because of the flexibility of holding the contract for an indefinite period of time without worrying about the swaps. Okay. Let's move on to the second part of the seminar, which is the COMEX Gold trades. Over here, we are looking at the COMEX E Micro contract size. So this is the 10 ounces contract. As you can see, the spread is the price is 1672.4 bid versus 1672.5 ask price, and that's a 10-cent spread. Right, as mentioned, the contract size is 10 ounces. The initial margin to start one lot of a micro lot COMEX Gold only requires 627 US dollars, or you can deposit the equivalent in Sing dollars. Once you have the amount of funds in the account, you can enter a trade. The smallest stake seen here is 0.1, and that equates to 1 US dollars. The account's funds you have is $627 exactly. So we can place a trade to buy COMEX Gold, or we call it long the position, at the price of 1672.5. Let's assume that the prices rises and it rises to 1677.5, and we sell the COMEX Gold back to the market. This is a difference of $5 in the price of gold, which equates to 50 ticks. As one tick is equal to 1 US dollar, 50 ticks would mean you have made a profit of 50 US dollars in this trade. So the round trip commission, 3 US dollars after deduction, will give you a balance of $674 in the account. So this is an example of the positive trade where you make a long position that goes in the favor and take the profit. Next, we'll look at another example of the COMEX Gold trade using the same COMEX Gold 10-ounce micro gold contract size. In this example, the count of funds varies a bit. Instead of exactly 627, we have 1,000 US dollars. Sufficient to do one lot, but not enough to do 2 lots of micro lot size. So similarly, we also long or enter for buy position for this micro lot size of 1 lot at 1672.5. In this example, we do not close the position at the end of the day. Instead, we leave it open. And as mentioned, the COMEX Gold will actually mark the contract to the settlement price at the end of the trading hours. So that will be 1682.5. Assuming if that's the settlement price, you will see an increase of $10 in the price of gold. That will mean 100 ticks, and that will equate to 100 US dollars profit. Except that this $100 profit is actually an unrealized profit because you have not actually exited the position yet, and it's only marked to the settlement price. So the following day, if the market goes up further, you can make a bigger profit, or if it goes against you, you actually make a smaller profit. So it's still subjected to the market price. However, on your statement, you'll be able to see on the following day the account balance of 1,000 US dollars, which you started off with unrealized profit of 100 US dollars, which gives you an account balance of 1,100 US dollars, still subjected to the deduction of the commission. So this is an example of maintaining a long position for a longer period of time that's profitable. What has happened if the position is actually not making the money, which is having an unrealized loss? We'll take a look at the example right now. So using the same contract size to make it easier to understand, we have a contract size of 10 ounces for the micro lot size. The initial margin is 627 US dollars. We have also 1,000 US dollars in the account, just enough to do one lot, but not enough for two lots. So let's go ahead and buy one lot again at 1672.5. However, this time instead of rising, the price of gold actually plunged quite substantially to 1622.5 within the day. So at market close, let's say the settlement price is at 1622.5, you'll see that there will be a difference of $50 in the price of gold. That will mean a 500 ticks difference, and you'll be making an unrealized loss of 500 US dollars. So the account balance will actually be 1,000 minus 500 unrealized loss, which gives you an equity of 500 US dollars. However, as mentioned, you need to maintain your margin of 627 at all times. So you have to take that into consideration, and you will find that that's a shortfall of 127 US dollars, which triggers a margin call. And you will need to do the top up to the account within 2 days. Else the positions will be liquidated on T+2 if there's insufficient funds to maintain one margin lot size. So I hope you're following so far with the calculations. All right, next we'll actually go into the discussion itself proper on the gold prices, fundamentals, and movement recently. So the first thing we look at when we talk about gold is actually the gold-US dollar relationship. Gold is the oldest currency in history. During times of fear or geopolitical turmoil, the price of the metal tends to rise. For example, during times where there's no conflict and stability, it tends to fall. The US dollar gold price is a widely accepted benchmark in the world. As such, there's generally an inverse relationship between gold and the US dollar. When the US dollar rises, the price of gold falls, and vice versa. Here is a bar chart which depicts the prices of gold and the dollar index, which is an indicator of the dollar strength from year 2000 till date. We can see that the inverse relationship holds for most part of the time. The value of the dollar is not tied to the value of gold, but the gold price is actually linked to the value of the dollar. Hence, it's important to always consider factors that may affect the dollar, the US dollar, which are interest rates, monetary policies, and inflation. So this brings us to the topic of inflation, and we'll have to look at the inflation figures of recent times. Well, inflation is on the rise globally, as you are quite aware now. Eurozone latest figure is at 10.7%. The UK is at 10.1%. The gauge for the inflation is the Consumer Price Index, or CPI. Especially in US, it is a most used measure of US inflation. The October reading for the US inflation reading for CPI is 8.2% year on year. That has changed last week, which has a drop to 7.7%, a drop of 0.5%. So it has been on the rise until last week, since June last year. And the pace is actually very quick in picking up. The recent months show that the pace of increase has slowed down, and the last week reading has shown us that it actually decreased already. start to decrease. So this serves as a pre-indicator that inflation rate seems to be under control. That is what the Federal Reserve has hoped for with a series of aggressive rate hikes in recent meetings, which is specifically targeted to increase the cost of living and discourage spending so as to achieve the overall drop in the price of goods and services. In other words, the intention is to induce inflation to actually fall. This has resulted in the appreciation of the US dollars, referring to the increase of interest rates that has caused the dollar to increase. Therefore, if inflation remains high, the Federal Reserve will likely to continue to hike interest rates further until they get a control of the inflation situation. But fortunately, there are some improvements from the last inflation figure, and we have started to see the market taking an approach that inflation has actually come to probably near the peak, and the Federal Reserve might be considering a tapering down of the increase of rate of interest rates, or even maybe in the near future start to consider decreasing interest rates once again. That will be discussed later on, but the objective for this is that inflation actually affects the US dollar, and that is something to look out for, which is the inflation figures from all around the world. Right, so next we'll look at interest rate hikes. The Federal Reserve has been aggressively raising the interest rates by 75 basis points each time for the 4 times that it concurs in meeting. So currently it is at 4%, and they have been pretty open on their interest rate policies so far, which is giving you a very good idea of what they intend to do. So far they have been delivering on what they have said they would do, and it's still expected that more rate hikes are still lined up into 2023. However, probably not as high as 75 basis points as from previous rate hikes. It is expected in the overall big picture, they are looking to raise interest rates from 4% currently to 4.75% in 2023. So there's still some bit of room for rate hikes, but we are certainly near the end of the cycle if all things go as planned, right? So there have also been talks among the Fed officials of reversal, and some even say it's too early to talk about it, but it is all not still set in stone. So if the Federal Reserve does indeed put a pause on rate hikes for the next month, December month momentarily, this could mean it provides some relief on the downside pressure of gold prices. If in the future, after inflation is brought under control, Federal Reserve can also start to roll out rate deductions. We could be looking at the final stage of gold prices reaching the bottom in 2023 or even right now as we speak. It is also worthy to note that since 15th of September, the Federal Reserve has also stopped buying the mortgage-backed securities MBS altogether. So officially, this is the start of the process of quantitative tightening as opposed to the quantitative easing. The entire episode of MBS on the Fed's balance sheet started in late 2008 when the Fed for the first time started buying MBS as part of QE1. The purpose of the MBS purchases was to repress mortgage rates and inflate home prices back then. That process has already started to reverse. The last time the Federal Reserve actually did quantitative tightening was in November 2017 to February 2020, which is before the COVID. During the last episode of the quantitative tightening, the Federal Reserve has shut MBS from November 2017. So this is actually only a short period of time. This time, the pace of assets purchases reduction is way faster than the previous time, as they had to tackle the problem of inflation. Right, so after talking about inflation and interest rates, we'll look at the fundamental supply and demand factor that will affect gold. When talking about demand and supply, central banks are one of the biggest market players since they have the biggest capacity to do so. Global central bank purchases leapt to almost 400 tons in Q3 of 2022. It's an all-time quarterly record. This leaves the year-to-date net purchases to 673 tons. From the chart, you can see that this surpasses all the annual total purchases every year. So this is indeed a record. This can be seen in the recent rise in gold prices as the central banks accumulate their gold reserves. Among large buyers were the central banks of Turkey, Uzbekistan, Qatar, and India. But the World Gold Council (WGC) said a substantial amount of gold was also bought by central banks that did not publicly report their purchases. It did not give any details on which countries this could be, but banks that do not regularly publish information about gold stockpiles include those from China and Russia. Offloading of bullion by ETFs helped push gold prices down 8% in the third quarter. But this price fall helps to stimulate demand for jewelry. The World Gold Council actually mentioned this. Looking ahead, the central bank buying and retail investment remains strong. Jewelry demand continued to perform strongly in some regions, such as India and Southeast Asia. So this is actually a very strong demand outlook for the gold prices, since there's buying all around from the retail sector to the institutions. Right, we have covered the fundamentals for the gold prices. As usual, we'll also look at technical charts, as fundamental factors give us a pick on the direction of the market in the broader picture. But the technical charts help us to identify the price levels that are ideal for entry and exit. We also see if the technical picture paints the same picture with the fundamentals, which we discussed earlier. So let's get right into the technical chart. This is the continuous daily chart for COMEX Gold Futures from tradingview.com. Prices were at the peak in March 2022, as you can see at the top where the prices are, and has been steadily on the decline until recent times. This chart was taken from last Friday. I think current prices are even higher right now at 1,700 handle, 770 perhaps. Yeah. So it's notable that this coincides with the implementation of the Fed policy of increasing rate hikes and quantitative tightening. So the whole process of the rate hike increase, you can see it goes in the opposite direction with gold prices, which pressure the gold price. We can see currently the price of 1,630 has been tested 3 times, 1, 2, 3 times here, and it did not break the support. This makes this a very strong support of gold and an important support level to watch out if the gold prices break below here, which will indicate a continuation of the downtrend. However, we can see that gold prices started rebounding sharply over here. This actually coincides with the announcement of the CPI figure, which is the inflation indicator that has come down from 8.2% to 7.7%. And the market takes it in stride that inflation has actually come to close to the peak, and probably Fed policies are working and they're getting a grab of the control of the situation. And in doing so, the Federal Reserve might consider putting a pause on rate hikes. This caused the gold prices to start to bounce off together with the recent purchase of gold from central banks. And of course, we can see that gold prices has actually further bounced up furthermore from Friday and Monday's movement, which is a good sign of the bounce off, which is a very strong bounce off. So 40 days moving average is over here depicted by the blue line. Yep, this blue line over here. The crossover of the prices of the 40 is also the first hint that there's a reversal that might be going on and prices have indeed bottom up. So typically when there's a crossover, there's a chance when the prices come back and dip into this 40 MA line again, that could serve as a good opportunity or entry level. So we have to look out when the prices come back to this line again. That might be a good consideration if you have missed the first part of the movement. So I've also drawn out the resistance levels for you, indicated by the green lines over here, which are 1,736, 1,770, and 1,818. These are possible target levels if you want to exit the position to take profit along the way, which means when they reach the resistance, there could be some retracement or indecision. So you can actually take profits over those levels. So the temporary support level is a psychological level of 1,700. Is to be considered entry levels also if you are looking to buy. Overall, we can see that the technical picture shows us some signs of bottoming out. So if the Fed is to slow down the pace of rate hikes, which is coming next month when we meet again in December 14th, the pressure on the gold price might be lifted and we can see further increase in the gold prices if that happens. And going into the first half of 2023, we have to continuously monitor whether there is actually a recession coming up, how the inflation figure is going to be, and if the situation continues to improve as what we are seeing now. If that's the case, gold may be a good choice and a safe haven for you to park your funds in. Well, amongst the other choices, of course, are the interest rates, deposits, and everything. But if you were to speculate the price of gold, it would be good to hold on, go into COMEX Gold Futures as an option because you do not have to pay interest for an indefinite period of time. So that sums up for our analysis so far on the fundamentals and technical analysis for gold prices. All this can be traded on our Phillip Nova platform, which is accessible via your phone or from the PC or desktop. We have almost come to the end of the webinar. I hope you find the information useful so far. Let me just touch on the available services offered by Phillip Capital. If you sign up for the account, which is available online using my QR code that will be shown later, I'll be providing WhatsApp economic data updates every week. There will also be technical discussions that I've shared with you today on trades and products that you're investing in, and I'll be assisting you with any questions pertaining to your account or trading. I cover markets on Forex, global indices, precious metals, energy, and commodities. You'll still be executing the trades yourself, but you have a second perspective on the technical aspect of the trades. With regards to the daily trading highlights, our in-house analysts also email technical reports on suggested levels for your reference. This will be on suggested entry and exit levels for your consideration, also on gold prices. It will be sent as daily trading highlights, showing directional views from a global research desk of Trading Central. This can be starting points for your own research to identify opportunities that make sense for you. Other pairs include in this report stock indices and commodities, namely the S&P, Dow Jones, Nikkei, the China A50, Nikkei 225, and crude oil. For the fundamentals, we are also covering it with our commentary reports to give you updates on the economic news that's happening around the world. This will keep you updated on the latest economic news that might have potential impact on the markets. This saves you the work of searching for it yourself on the internet. The daily commentaries are on gold and crude, which provides insights to recent events that might impact gold and crude oil prices. Hence, over here with Phillip Nova, we provide the fundamental and technical aspects of trading information to you. And you can also have a dedicated broker, if you may, to assist you if you have any questions regarding the market or your account. So beside the analyst reports, you can also reach out to me via WhatsApp on technical views on the trades that you have as well. So let me just share on the ongoing promotion for the account opening that is ongoing until the 31st of December. In conjunction with the FIFA World Cup, when you open an account, simply make a deposit of 1,000 Sing dollars and place a trade of any size, can be as small as a 1 micro lot size. You will have a reward of 100 Sing dollars credited into the trading account. The reward will be credited 2 weeks after the end of the promotion, but can only be withdrawn 3 months after the entitlement. Well, this is actually a very good opportunity, so feel free to open the account using this link QR code over here and get familiar with trading in micro lot sizes first. Trading gold futures with Nova is also very easy on the desktop. We have as well the mobile app to trade on if you are on the go using a mobile phone. If you're interested to get started, you can open a live trading account with Phillip Nova at zero cost. The entry level is very low. As mentioned, the margins for each micro lot size is 627 US dollars. If you have been thinking of opening an account to trade gold, this is a good time to start when the market is starting to turn. With low commission rates as low as $1.50 per lot. You can get started with the account opening first and trade live whenever you are ready. There is no admin fee for opening an account and maintaining an account for any period of time. So the process is very easy using SingPass and can be quickly done within minutes. Simply create an ID by scanning the QR code shown here. This link will be tagged to me, so I'll be assisting to you from the process of opening an account and after when you're starting trading. So alternatively, you can also use the URL as shown, which is indicated beside the QR code. Foreigners can also open an account online via the QR code. If you have any queries, feel free to drop me a WhatsApp message or email me. My contact information will be given to you at the end, at the last slide. So I'm sure you have certain questions. I will try to answer them now. What's the amount to open the account? Yeah, we have an ongoing promotion right now, the FIFA promotion, which you can actually open with a deposit of 1,000 Sing dollars. Once you've done any trade size after opening the account, 100 Sing dollars will be credited in the account. So if you wish to participate in the promotion, you can deposit 1,000 Sing dollars. However, the amount to trade 1 micro lot size is 627 US dollars. So that will be the minimum for you to actually put in if you want to trade 1 lot size. You can also open an account without depositing funds first and get access to the high prices as well. And at any point in time when you want to start trading, fund deposits can be easily done via online using Pay Now, be credited within 20 minutes and you're ready to go. Is there a maintenance fee to open an account? Yeah, as mentioned, there's no maintenance fee at all. So you can open the account for free and there is no cost in maintaining an account or access to live prices. But you may need to renew access to the live prices due to dormant accounts after a period of time of 6 months or so. Is demo account free? Yes, demo account is actually free. So we have the demo account link here on the left for the Phillip Nova. Feel free to scan it and open a demo account, give it a try, and if you are ready, you can also use QR code to open an account on the right. The other question is coaching chargeable? Coaching is not chargeable, so we can arrange a session at an office at Raffles City Tower. Simply just scan the QR code and the next slide to book a coaching session with me, and the content of the coaching is actually on technical analysis. I'll share with you for the chart reading what are the the points for beginners to look out for and the indicators I typically use, or how do I read the charts myself. Next question, do you provide stocks too? Yes, the Nova platform is a platform to trade on two kinds of products. One is the mentioned futures product, which is COMEX Gold Futures. It's also available to trade stocks and shares. So you are able to open one account, which is a multi-platform for different kinds of products, including stocks, futures, on one single platform. However, if you wish to trade Forex and CFDs, you would have to use the MT5 platform. Both platforms can be opened for free, so when you scan the account opening link, simply choose the MT5 as well as the Phillip Nova in order to open both accounts. And the promotion applies to both accounts. So the $1,000 deposit in any of this trading platform and a single trade will allow you to be able to be entitled to the $100 reward. How does Forex Mini Gold compare? Yes, so as mentioned earlier during the discussion of product, you can see the COMEX Gold Futures as compared to the spot gold. And typically, people will ask, should I trade the spot gold or the COMEX Gold Futures, right? That really depends on many factors, but I think the most important thing I realize is people would actually consider whether they were actually going for a longer time frame or shorter time frame. For gold itself, the gold prices are actually very volatile, so I would actually suggest not to hold too long a time frame unless there is a very decisive direction or trend going on, which is happening exactly started since last Friday after the inflation figures. So I will think the COMEX Gold Futures will serve the purpose for a longer position. And if you are looking for more intraday trades, the spot gold intraday trades, meaning you close the position before you go to bed, the spot gold will actually be a better choice, because if you are going for long position on a Forex gold or FX gold, that will actually incur costs on long positions, and the swaps are quite high for that, and you would not want to pay that for a long-term position. So in short, the answer will be, if you are looking on long position and a longer time frame, you go for COMEX Gold Futures. But if you are looking for a more shortened time frame, the FX Gold will be a better choice. All right, another question, Phillip Nova and Phillip MT5 有什么区别? So what's the difference between Phillip Nova and Phillip MT5? So basically, it's the product that's traded. For Phillip Nova platform, it allows you to trade futures contracts, 就是期货，还有and also the stocks and shares 股票。所以if you are trading on futures and stocks and shares, you'll be opening the Phillip Nova platform. But for MT5, it focuses on Forex, which is the spot contracts, as well as CFDs on stocks and shares and indices and commodities. So depending on whether you are going to trade on a certain particular product, we will advise a different platform for you. So feel free to approach me if you have questions or interest in a certain product and you need advice on which platform is more suitable for you. Just drop me a message or email me, or I'll get in touch with you shortly once I receive your email. Can I just see if there's any other more questions out there? Okay, I think that's about it. Thank you for joining us. So if you want to try out the demo Nova account, you can scan the QR code over here on the left. And if you want a live trading account, you can scan the QR code to the right. And okay, there's one more question. I'll touch the last question for the. What's the commission for mini gold on MT5? It's zero commission. So basically, the entry price you enter for on MT5 and exit price, the difference will be your P&L. That's for intraday trades. There's no commission. You do not have to pay anything, just the spread difference of the buy and sell price. And However, there are swaps for overnight trades, so that's something to really consider if you're going for longer term. The Forex mini gold on the MP5 will incur swaps, and I will not be able to advise a specific key figure, but if you're interested, feel free to approach me. I'll give you examples of certain days on how the swaps are going to be. Yeah, opening of account is free, so you can actually simply open the live account and take a look at the prices also. All right, so this is all the time that we have for today. Feel free to drop me a message or email me if you have any queries, or if you wish to have a coaching session, just scan the QR code over here on this slide. So we'll have come to the end. Thank you for being such a wonderful audience for tonight's webinar. A link of this recording will also be emailed to you with our follow-up email tomorrow. If you have any query on the webinar or would like to get started, simply reply to our email and I'll get in touch with you. So this is Phil again. Thank you once again. Have a good evening ahead. Good night.